Well, I have to be honest, Palantir has given us a wild ride so far. I mean, some of us loaded up in the $6 to $9 range, but then there's other folks who are holding the bag on a lot of shares. I mean, just this year, it's gone from in the teens all the way up to almost 30 and everywhere in between. And then there's some of you guys out there that are looking to build out a position because you're finally on the Palantir train and you're wondering, what is the right way to do that? Well, guys, I'll tell you the right way to build out a position in Palantir stock, regardless of what situation you're in, so that way you avoid some of the disasters that people find themselves in, and instead end up with a nice, large position in a great stock. And you can apply this to any stock in the stock market, guys. So it doesn't have to be Palantir. You can apply this to any stock that you want to build out a position in. The strategy is exactly the same. Just make sure you like the video if you like getting the truth out the hype, guys, and make sure you do that for all the creators that you like out there. And if you like educational videos like this, where it's a little less, where's the stock price going, and much more on strategy, how to actually execute and create a plan and kind of move forward in regards to, in this case, buying Palantir stock. So I'm actually going to give you two different ways to do this so that way you can kind of look at both, and they're intended to be modified a little bit. Modify them to your needs, modify them to your thoughts. That's okay. And I'll kind of show you how I do that as well, so that way you can kind of get an example of how to do it. But I'll give you two different ones and you kind of choose the one that's best for you. One is going to be more for beginners. One is a little bit more advanced for those folks who want to put in more work, want to put in more due diligence, more importantly, and have a better understanding of the market. So you can kind of start with the first one, and then kind of graduate down to the second one as you gain more experience in the market. But before we get into those two, let's discuss what you have to avoid first. So what exactly do you have to avoid? Look, guys, this is not Luke's opinion. I'm using statistics here to actually prove this point. What you have to avoid is trading stocks, getting in and out of stocks, shorting stocks, going put options and call options and all this other crazy ridiculous around stocks. But bottom line is trading underperforms dead people statistically. Statistically, trading underperforms just a simple index fund. It is absolutely, when you actually look at the statistics, it is the one that performs the least effective out of the group. I'm sorry, those are the numbers. That's the data. That's the proof. Now, of course, Wall Street is going to tell you the exact opposite, but go look at the performance of hedge funds versus the actual returns of the market themselves. You see that the vast majority of them underperform. Sure, some overperform some years, but the vast majority of them over the long run underperform simple index funds and dead people. Yes, you can trade and you can be winning in the short term, but over the long run, they always end up underperforming, guys. It's just, you can't get away and you can't negate the effects of compounding. Some of the other market effects that happen. Oh, and by the way, more importantly, whenever you take out like the best 10 trading days over the past 20 years or something like that, you end up missing out on like 600% worth of gains if you just happen to miss those days. So what are the chances over the course of 20 years you happen to guess right on all 10 of those days? Out of all the different trading days in there, you end up making the right trade on the right day on those 10 times. Those chances are very small that you're going to hit all of them. Matter of fact, you're probably going to miss on most of them, meaning you're going to automatically be significantly behind everybody else who just continue to use the strategies that we're going to talk about next in order to actually invest. The statistics are just shocking, guys. There's no need for me to regurgitate them here for you. Go ahead and look them up. Even Goldman Sachs has studies out there on this, and they've shown that, basically trading underperforms the strategies that we're going to talk about next here. So there's no point in doing it at all whatsoever. I understand it's the popular thing. I understand right here on YouTube, there's lots of folks telling you they know exactly how they can get in and out of all this sort of stuff. They just can't, guys. If they could, they'd be trillionaires. And as far as I know, there's no trillionaire investors out there. So nobody can do it with any degree of accuracy. I talked to Warren Buffett, talked to Peter Lynch. Sorry, I believe those guys over a lot of other folks out there who are saying that they can do it. You just can't do it consistently over the long run. Not saying you can't make great trades, but to do it consistently over the course of a 5-year, 10-year, 20-year period just isn't realistic. So let's get that out of our heads right now. We're not going to trade. So strategy number one is a simple DCA. All right, so DCA, dollar cost averaging. Essentially put it on a schedule, buy, and don't look again. Just make it automatic. Then you don't deal with emotions. When the market's running hot, you're buying. When the market's running low, you're buying. So essentially you get your paycheck, whatever goes into your investment account after you've taken care of all your bills and everything else. Let's say it's $500 a month, $1,000 a month, whatever the dollar amount is. You take that money and every week, every 2 weeks, however you choose to set up, once a month, whatever you choose to do, you buy your basket of stocks that you want to buy. And you do that consistently on the schedule, whether the market's up market's down. It doesn't matter. You just consistently buy and put that money in the market. And over the course of time, you will outperform index funds, hedge funds, everybody out there playing all these games and, talking all this other stuff and all these crazy strategies and everything else. You can sit back, relax, and know that statistically, you're going to outperform them with none of that craziness, none of that stress, none of that work, none of that following this and watching that and checking for this indicator and checking for that indicator and watching charts and graphs and lines and, all kinds of other ridiculous stuff like that. You don't have to do any of that. Put it on a schedule, do it. You can probably set it up to automate some sort, and you will be better off over the long run than all those other people playing all those other games. So just execute a simple DCA. Now, the next strategy is the one that beats out a simple DCA. It's not by a lot, but it does beat it out, and that's the one we're going to talk about next. And that would be a modified DCA. Now, this one is a little more complex, and we'll get into it here. But the reason why I use a modified DCA, this is the one that I use versus a regular DCA, is I want to avoid those high times, those times whenever just stocks are sky high. And we're using Palantir here as an example. So whenever I think about Palantir, the reason why I didn't buy at $40 whenever it was up at $40 or even close to $30 this time around, this year, is because I use this strategy, which means I stop my DCA whenever the stock gets above fair value. I stop DCAing. And then whenever it gets down below fair value, I start DCAing, and as it falls, I DCA heavier and heavier and heavier. That's why the bulk of my shares were bought in kind of that $6 to $9 range or so with Palantir. So no, I didn't buy shares up at 40, and no, I didn't time the bottom right either, but I bought a whole bunch of shares around that bottom, and of course, everywhere in between, because I implemented this strategy. So let's kind of go through the steps of the strategy so that way you can do it too. So basically, the first thing you got to do is do evaluation. I know we talk about it here. Please learn it, Google it, put it in the search bar right here on YouTube. You can join my group. We talk about it in there, have 4 courses on it and everything else that you can, go through and have all of us help you do it. Doesn't matter. Learn how to do it so that way you know what fair value is for Palantir. And then once you have that fair value, set your price target where you want to start your DCA at. You can set it right there at fair value. You can set it a little bit below fair value. For me, I own a whole lot of shares. I basically have a full position plus, so I'm just looking for bonus shares. So mine's a little bit lower than maybe where fair value is because I want, cheap shares, discounted shares at this stage because I have all the shares that I want. Either way, do that valuation, get that price target, and then whenever the stock hits that price target, you just start DCAing. You don't think about it, go, ooh, it's gonna go lower. What happens if this happens? What? No, I know exactly what I'm gonna do. I'm gonna start DCAing right there. And let's just say $20 is fair value for you. You can place it wherever you want. Let's just say it's $20 to make the math easy here for us as we work through it. Cool, I'm gonna start my DCA. I'm gonna DCA into Palantir right there. Bang, hits that $20, I'm DCAing. Oh, what do you know? It drops down to, $17.50. Okay, maybe that right there will be the next time I DCA into it again. But if it does, I DCA a little bit heavier. Okay, well, maybe the next month it goes back up to 19. Okay, so I'm going to DCA into it again, but a little bit less. Oh, man, but now it craters all the way down to 15. Well, now I'm going to DCA a lot heavier. And you kind of see how that kind of works. And of course, as it works its way back up, gets back up over that $20, I stop my DCA and I go look for other opportunities in other stocks. Sure, sometimes all my stocks move at the same time, but when you have a larger portfolio I do, what you realize is, hey, sometimes these stocks are moving down and these are going up. Okay, well, I'm going to direct my money over here. And then these get overheated, negative news comes out, they kind of go down, these start to go on a run. So, all right, I'm not going to buy over here anymore. I'm going to buy over here at these as they start getting discounted. And it's kind of a rinse and repeat process in regards to this. And I really do just keep it that simple. I don't care if the charts are all pointing to it's going lower than what it's at. Okay, cool. Well, I'll DCA on the way down. I keep it very, very simple so that way I keep emotions out of it. I keep the trading out of it, and I just execute based upon that plan. Now, I know the question a lot of you guys have is, Luke, how do you apply this to more speculative companies? How do you do that? Because it's hard to get evaluation. It's hard to get price targets. And more importantly, they're speculative. Well, that one is a little bit more nuanced. And for me, this is just my strategy. When I'm dealing with a speculative stock, they have to earn my money, which means I'm not just simply going to DCA into them because the stock price is going down. Whenever I think about Palantir, that's a performing company. That's not a speculative company. They're churning a profit and they are moving in the right direction. So I don't need any more proof that they're going to make it per se or anything else like that. I know they're going to make it, so I'm going to continue to DCA into that stock. But a more speculative stock, I don't know if they're going to make it or not. And I don't care what the stock price is. That stock price can drop down. But if they're not performing on earnings and earning more of my money to DCA into that stock, I'm not buying anymore, regardless of what the price goes down to. It doesn't matter at that stage because they've got to earn more of that money because they are more speculative. And that's one thing we've all learned from this time around. If you didn't, you're going to learn it sooner or later here in the market is when you start buying speculative companies and all of a sudden they don't perform. Yes, stocks do go down to zero. Stocks do go bankrupt. Stocks do go away. Retail learned a huge lesson after that 2021 super cycle up that, hey, you own junk, it is going to go to zero in regards to that junk. So know when I'm dealing with speculative stocks, they have to earn they have to earn more of that money. While Palantir was still trying to figure that out, I was not just adding every single time it dipped. It was, hey, let me wait till earnings. If I like what I see on earnings, they're going to earn more of my money. And as those earnings got better and better and better, they earned more and more of my money. And it made that DCA stronger and heavier as they kind of turned from one to the other. Things aren't absolute, guys. They kind of go on a curve. And as they executed, you could see, wow, this company's printing money. Guess what? You need to look a little deeper than just the headline numbers. You need to go to that free cash flow and just go, man, there's so much free cash flow coming in here. This company really is able to turn a profit anytime they want. That comes from your due diligence. That comes from them proving it quarter in and a quarter out. I don't care what the YouTube narrative is. I care about what's going on with the company, with the fundamentals. And we saw with Palantir that basically the fundamentals kind of decoupled from the stock price. That is the perfect scenario you want as a long-term buy and hold investor. Hey, Palantir wants to turn profitable. Everything's looking up. Alex's guidance is great. And Wall Street wants to beat it right back down again. Awesome. That just means I got more shares on the cheap. So I was able to really heavily DCA that kind of last, 3 months or so we got where Palantir fell back down into the sevens before finally getting up over 10 and of course rocketing up over 20 now. That's exactly what happened there. And that right there was kind of that last grasp opportunity at super cheap shares like that. And using a modified DCA allowed me to really, really add heavily during that time and enjoy those extra bonus shares at really, really cheap prices. Am I still buying Palantir? Yeah, absolutely I am. But I'm not getting opportunities like I got that time around. But that's okay. Remember, share count is what matters in the end. And that right there is what I'm focusing on, is continuing to build out my share count in great companies that are performing. And I want to buy those shares at undervalued prices, and using a modified DCA is exactly how I do that. And if you want to walk hand in hand with me and walk through the 5 courses, walk through our free coaching, walk with me on the live Q&As and on our Discord and everywhere else about how to do this, how to execute a DCA, how to do evaluation, how to do due diligence on a stock, make sure you check out the pinned comment for my group where we do all of that. And I may have left a special price for you guys down there for those of you guys that have made it this far in the video. So check it out. It's the pinned comment down there and see exactly what you get with the membership and see if a membership's right for you. And click this video here if you want to see exactly what I'm buying in this market, and click here to see my exact plan for this market. So thanks for watching, and we'll see you in the next one.